Hey there, my name is John Stevenson. Welcome to the Guaranteed Retirement Guy Show. Today, we're going to be answering a pretty important question, which is, can an annuity prevent me from running out of money during my retirement? If you're retiring soon, or maybe you've got a few years away from it, or maybe you're already retired and you're thinking, I want to get out of the stock market, I want to have some protection, but I also want some growth, and I don't want to run out of money, and I don't want to go back to work, okay? Those are really important concerns that many people have, and it's important to make sure that you don't run out of money because, of course, if you run out of money, you don't want to go back to work, and so the only way to do that is just make sure you have enough money. You're withdrawing, a small amount. Hopefully it'll last until the time you think you'll die. Or you can use an annuity contract to basically give you a high payout, much, much higher than you would normally pull out of your account. Because a lot of us, when we're wanting to make sure we don't run out, we'll look at like a 4% safe withdrawal. Or maybe it's less than that, just depending on market conditions. So, but you look at that and say, all right, well, I got to have $1 million, to have $40,000 a year. But what if the stock market drops, really hard for like a year or two? What happens then? Well, of course, you're not going to take out 40,000. Okay, you're going to take out less. You want to make sure you kind of conserve that. And so, an annuity is a great option because it gives you contractual income and it never runs out. It is a contract. Okay, it's not designed to keep your account balance around forever. Although, you can have a refund to your beneficiaries of whatever balance is not used, but it's a way to leverage that amount for a much higher pension for that retirement. And when the market slips, which it often does, you don't have to worry about your income going down because it's never going to run out. That is what it's for. It's for the contractual income. Okay, so I'm going to share my screen. I want to show you exactly what's available. And if you would like, you can go to my website, johnstevenson.com. You can search through my calculators. The income rider typically pays out the most, but there's all options there. If you want to check, I get the data directly from Canex and Annuity Rate Watch, and they feed me the data from the carriers, which allows you to be able to kind of do your own research and decide which one is best for you. And then if you want to book a call with me and you want to chat about an annuity for yourself, I'd love to help. There is a link on my website to do that. And there's a link below this video to book a call with me. So it would be a Zoom meeting. So I would share my screen and we can kind of go over all the options. Okay, but let's take a look at my screen. Let's go over some of these right now. Okay, so what I did is I just threw a married couple in here. They're 62. They want to retire at 65. And so $600,000 is what this particular couple wants to put in. They're in Florida. And they're thinking, all right, well, I want to put $600,000 in, and I'm not going to retire until 65. I'm going to work till 65, or maybe I'm going to live off of savings, or I'm going to live off of something else, okay? And a lot of people will do this so they can maximize the payouts from their annuity contracts, okay? So they take $600,000. It's not all of their portfolio. Maybe it's only 30% of it, okay? But what they're doing is they're putting that in, and it's going to give them this payout. You can see these are all the options. Let me just top annuity per carrier so we can just kind of see everything here. All right, so you got Nationwide, Corebridge, F&G, ClearSpring, Nassau, and several others. You got Mass Mutual here, got Prudential. It's a lot of good options. So if you're looking for highest income, though, Nationwide is it, okay? It may not be that when you're watching this video, but that's what this is showing right now, $55,000, and that's guaranteed for the rest of your life and your spouse's life, okay? Now, if you weren't married and you're 62 and you're still taking income at 65, does that change the income? Typically, it does. Let's see what it does. All right, so you're getting like $3,000 more a year. That's not bad. Yeah, and the only difference here is if you look at Nationwide, I'll just pull up Nationwide again just as we were comparing with the joint payout. What they're doing is they're giving you a different withdrawal rate for single versus joint. Okay, so for this one, if you let it sit and grow, they're going to take a benefit base of $930,000 right here. That's guaranteed. Okay, that's what the income rider is for. And that is multiplied by a 6.25% withdrawal rate, giving you $58,000 a year for the rest of your life. Now, this is a single payout, okay? Now, if I go back and I say, well, I'm married. I want to make sure it's joint. I don't want it to run out. If I die, I don't want my spouse to get whatever's left in the account and have the income stop, okay? I want to have that income continue. Then you'll pick joint. And let's just pull that up here. So with this one, you'll notice it is still the same $930,000 base. The difference is it is multiplied by a 5.95 withdrawal rate. Okay, that's the difference. So it's giving you $55,000 based off of that withdrawal rate of 5.95 versus 6.25 as a single payout. Now, when you get this contract, you'll see both. You'll see a 6.25 and a 5.95. And you'll say, all right, well, I don't have to decide now. I might take income at a 6.25 or a 5.95. Maybe you're planning on getting divorced, or maybe you're planning on getting married, or maybe you're planning on staying single. So it's very nice because a lot of these are flexible. They will allow you to do that. Now, not all of them will though. Okay. So just so you know, sometimes with these, you have to submit the application as a single, as a joint right in the beginning, and that's set. Okay. So that just takes proper planning. So some annuity carriers though will allow you to just put it in. They'll have the benefit base grow. And then of course you can decide at whatever time you want to, when to take the income and whether it's going to be a single or joint at that time. Okay. So in the way this 930,000, you know, this is a lot higher than the 600,000. It's because they're giving you growth, guaranteed growth, because of the income rider. So the income rider, they charge you for it, but they give you a lot of growth. So they're giving you a base bonus of 25%. So they're taking 600 grand, multiplying it by 25%, and then taking that, multiplying it by 8% every year. Okay. And I believe 8% might be multiplied by the 600,000. So you might be getting an extra 60,000 a year on that. Let me just look here. Yep, that's what it is. So they're giving you 8% simple interest. So they're giving you a benefit base that begins because they got that huge bonus, and then they add 60,000 each year. All right, so that's how it comes up to the 930. So a lot of these are different. Okay, some of them will give you an 8% compounded. Okay, some of them will give you a 9% compounded. Some will give you a 6.5, and it might be a simple or compounded. But the other thing you have to remember is the withdrawal rate has to be high, because I can get you something that's 9.5% compounded or even higher. But if the withdrawal rate's 3%, you're not going to be very happy. Okay. So it's all about highest income. Okay. And you can see here, highest income for a joint is $55,000, and that will never, ever, ever run out. And you can go back here. I'll show you. If you go back to, look at the account balance. Okay. That's not going to last. Okay. If there's no growth in the index, it only lasts till you're 74. Okay. If there is growth in the index, it'll last till you're 77. But the income is why you get it. Okay. And that is there forever. So this basically makes it so you never run out of money in retirement. You can take the same 60,000. Okay. Maybe grow it. Maybe you can grow it to 700 grand during 3 years, but it's not guaranteed. And then off of that, you're like, all right, well, safe withdrawal rate. Maybe I could do a 5%, let's be optimistic. So I'm going to do 5% of my 700 grand. All right, I'm getting $35,000 out a year, but if the stock market crashes or does something, then I got to, maybe pull back a little bit, but man, I really like more income. Okay. How can I get 55,000 from 700,000? Well, that's going to probably make it a little bit more uncomfortable, because you're like, in order to do that, I got to be really aggressive in stocks. And I know that's not going to always materialize. And so you're going to be frustrated a lot. You'll be stressed out. And so a lot of times what people do is they'll get these annuity contracts so they can give a high payout. They just take the portion of their money that they need, and they put it into these contracts so they can get this high guaranteed contractual payout that they know will always be there. That's what they're doing it for. And then if they want to invest the rest of their money in the market, they can do that. And that works well for a lot of people. So anyways, hope that helps. I hope this is answering your questions. If it isn't, comment below and I'll answer those questions for you. Or if you're looking to purchase an annuity and you have more questions, then book a call with me. There is a link below this video, and there's a link on my website, johnstevenson.com. You can also go there and check out my annuity calculators, find out for yourself what the payouts are for you, because it's different for everyone. These are just examples. These are real time life examples, but you might be in a different state, different age, married, not married, your spouse might be a lot younger, and it might make sense to do different combinations of annuities for your particular situation. So anyways, that's what I would invite you to do, is go to my website, check things out. If you want to chat with me about getting my help to purchase an annuity, I'd love to help you, but that's up to you. I want to make sure that you're comfortable as well. It's really important. When you're working with advisors, there's so many advisors out there. They want your money. They want to make the commissions, and I get it. But they better be showing you everything. Okay. They better be transparent, and they better be showing you the best options, even if they pay them the least amount of commission. Super, super important. A lot of guys don't do that. A lot of guys are just like, well, I'm just going to pitch this because I want to make this. And I'm like, okay, well, this other product pays them a lot more. Can you sleep at night? Some of them can, but I can't. I think if you're going to take care of people and you want those people to refer you, then you better take care of them really, really well, so that in hindsight, when they look back, they're like, oh, I'm so glad I used them. Instead of most people that I've talked to, they're like, I'm so mad that guy sold it to me, but I had no idea what I was doing and I trusted him. And I'm like, yeah, that's that's pretty normal. You hope that an advisor will advise you and they'll do it in your best interest, but a lot of times they don't. So that's unfortunate. And that's why I'm a certified financial fiduciary, because that is something that I have to adhere to. I have to show you everything regardless of what I'm getting paid. Okay. It has to be what's best for you. And it all evens out. Really, it does. And there are some of these that don't pay me very much and I wish I was making more. And then there's some that do pay me a lot, and it evens out. When you do what's right and you do what's right for the client, then you end up doing well anyways. So anyways, I hope that helps. I hope this is giving you some value, answers some questions. And again, if you like the video, like, subscribe, share. I really appreciate you watching, and we'll see you next time.